Good afternoon, everyone. Welcome to day 3 of the virtual refresher course on accounting standards. This virtual refresher is being conducted by the Accounting Standards Board of India of the Institute of Chartered Accountants of India and is being hosted by the Untitled branch of SIRC of ICAI. On day 3, we have a very eminent faculty with CA.Raghuram Iyer. He is a person who qualified in November 1984 and has been practicing in Mumbai since then. He specialized in derivatives and hedge advisory. Sir had secured rank 3 in intermediate examination and rank 4 in the final examination. Do I need to say anything more about him? So today he will speak to us on AS11, the effects of changes in foreign exchange rates, AS12, accounting for government grants, and AS15 on employee benefits. With these words, sir, may I welcome you to kindly commence your discourse. Over to you, sir.
Thank you, CA Deepa, and thank you, CA Ranjit, for having me here today. And a very good afternoon, friends. As CA Deepa mentioned, we are covering 3 standards today: foreign exchange, government grants, and largely the retirement benefit accounting. AS11 and 15 are fairly complex, and I'm sure a lot of you must have had great experiences in it, but let me add 2 bits of my knowledge. There could be some areas which are a little controversial. It is possible, and I will try and navigate through the nuances as much as I can. I hope you guys can hear me well. By and large, the way I operate is I open a blank Excel file and make my notes on Excel as I go along. I will email this file to CA Ranjit at the end of the session so that you can be the mail can be circulated among all of you, and all of you can get it by the evening today. And as we speak, any questions you might have, you can post on the chat box. Let me keep my chat box open, and whatever I can to help you in maybe clarifying your doubts, I will be happy to do so. There could be always issues in some of these complex areas that we don't know, or there are multiple answers, or maybe I have not seen that particular situation and therefore I don't know the answer. In those cases, I will promise you to get back after I do some more study. It always happens like that. Sometimes there are questions that are very rarely encountered in life, but they're very interesting and we learn from those questions. So I will be very happy to learn from you guys, and I'm very happy to be here and happy to be part of this journey of learning. With that introduction, let me go to my simple Excel file. Let me share a file with you. And if you permit me, I will put my video off because it's easier that way, and I think the transmission quality also becomes better. So you can focus on the Excel file that I'm presenting before you. And I can make the font larger if you wish. Maybe that will help you. And let me keep the chat box open so that my request is just post it on the chat. Don't put it on the question and answer. Just post it on the chat so that I have only one window to work with. So it's easier for us to navigate easily. So out of the 3 standards that we have, let me give you a little bit of background on where we stand today. AS11, the standard continues as it is, but a very large part of this area of work, which is maybe Forex or related forward contracts or related other derivative products, is not in the standard because the standard was written in an era where these were not very common. So we have an ICAI guidance note of 2021. This is the latest version, which has been built upon earlier guidance notes, which themselves were built upon, if some of you may remember, AS30. AS30 was announced but never notified because IFRS came in, or Ind AS came in, and Ind AS obviously covers this area pretty well. As a result of that, we found that AS30 never came. but AS11 continues in the books. So in reality, in practice, in this area, we read the guidance note more than AS11 itself most of the time. And I would also like to cover the contents of the guidance note here because that is really the real AS11 in practice. AS12 on government grants, I think, is the old guidance remains in place, and I don't think there is anything new that has happened. So that is probably the easiest one. AS15, the old guidance remains. There is again nothing that is earth-shakingly new, but the SMC standards that have come in 2021 have provided some relaxations for smaller entities, and that may be good to know on what relaxations are available now for the smaller entities, and that might be an addition to our regular knowledge. I believe that out of all these three standards, the simplest one is government grants. Maybe I can take it up first so that it's out of the way. The next one is probably AS15 because the guidance is more or less the same. And I think people in practice and people who have encountered this area will be reasonably knowledgeable about it. And the new concessions that are available, maybe we can spend a little bit of time on that and understand what these are. And then the balance of our time we might spend on AS11 because the guidance note is really quite a bit of work and quite a bit of knowledge is required to navigate. I just want to get your approval on whether this approach is okay and whether you want me to do something else, do something different. And with your guidance and concurrence, I will go ahead. Can I get some responses on the chat? I will keep quiet for 30 seconds so that I can get some responses on the chat. Okay, I'm not getting any responses, so I'm of the opinion that people are okay with that. And on that basis, I'm proceeding. I will request you to use the chat widely, friends. If it is interactive, it will be more interesting for you and for me also. So as far as government grants are concerned, I think there are many types of grants possible. And the guidance is simple and logical to my mind. And I'm not doing it technically, friends. This session, I'm doing it simply. I'm not taking you through para 1 and para 2 and para 3.5. That might be a little boring on an afternoon on an online platform. Rather, let us try and understand the gist of what is said there and whether it is logical to us, to our simple accounting minds or not. And then let's move on. That's the way I'm going to do it. I hope that approach is acceptable. If there are any revenue subsidies that we get, like for example, we get duty drawback, they would flow into the P&L based on the concept of accrual. I think that's something which everybody understands. Nowadays, we have schemes like SIES and MIES, which help exporters, and they would flow through accrual, but we have some practical problems, which I will tell you from my experience. Post-COVID, the government has not released SIS funds. This is, I'm talking about since, therefore, April 2019, people have not received these grants. So how April 2019, because these run by financial year. So 2019-20 financial year, which ended in March 2020, We applied in the last year, but we have not got the funds till today. So that's a fairly difficult situation. We are living in October 22. And so tons of water have passed through the Ganges and we are still waiting. In these circumstances, I believe that fundamental principles of accounting will prevail. And we can recognize such subsidies or grants on cash basis on the ground that collection appears to be difficult to estimate or improbable or maybe a low probability event. And on those bases, I think it is possible to recognize on cash basis. The standard here does not appear to prevent anything like that. Number one. Number two, some grants are based on your investment size and scale. And these are typically taken to capital reserve. So if I get an investment, I invest 25 crore in Himachal Pradesh, and that is a particular specified area, and I get a grant of 50 lakh rupees. Okay, this is more linked to the investment that I have made, and it could be in land building, or sometimes it could be employment related, etc., etc. This grant is taken to capital reserve. That is the simplest way to do it, and probably the correct way to do it. The standard talks about the same thing. Sometimes grants are linked to fixed assets. Say, government will give you rupees 40 lakhs if you invest rupees 10 crore into plant. If that is the kind of scheme, then the standard conceptualizes two possible ways of accounting, and both are available for us, and we need not necessarily choose. I mean, we need not argue this way or that way. Standard is already argued, and we will choose one of them and take that as our accounting policy choice. And what are the two choices? Rupees 40 lakhs is taken into capital reserve. That is one possibility, in which case plant is costed, sorry, not capital reserve. It is taken into a deferred liability, and rupees 10 crore is recognized or measured as plant costs. And over time, the plant will be depreciated. And over the same time, the deferred liability will be amortized into income. That is the first possibility. Of course, the plant may be depreciated on straight line basis or written down value basis. Both are possible. But the deferred liability is amortized on straight line basis. That is the standard practice, and that I think is a fairly correct practice also. Second possibility is that the government grant is netted off against the cost of the plant, in which case the net plant cost is rupees 9.6 crore, and obviously depreciation will apply on 9.6 crore. Now the standard provides arguments for both treatments and leaves the choice to us technically, that you do what you like, but we are okay with any possible kind of accounting. I'm not getting into why the first one is better or why the second one is better, because both of them have equally strong arguments, and I don't think we have the time to argue in a very theoretical manner on which choice of accounting is better. But I think that's about it. Now the standard also says or provides guidance on what if the grant is taken back in future. maybe you did not fulfill all the conditions that you were supposed to fulfill. In that case, what will happen is we will account for the take back logically. I'm saying logically because the guidance also really more or less says what we would have done anyway. So for example, if you have recognized a deferred liability, then you would first de-recognize that, or you will extinguish that liability because now you're paying back the government. Any spillover will be charged to the P&L. So as an example, if you received rupees 40 lakhs as above, out of which you have amortized into P&L, say rupees 8 lakhs, and rupees 32 lakhs is left, and you have to pay back, say, rupees 35 lakhs because you did not fulfill all the conditions, etc. What happens? How is that accounting now going to happen? And the answer is that you will first offset 32 lakhs of liability against the payment because you'll now pay the government. And the extra rupees 3 lakhs will be taken to P&L as an expense in that year because you're paying something more than the liability warrants. Or if you have offset the grant against cost of plant, meaning you have reduced the cost of plant to that extent, now you will enhance the cost of plant because you are now paying for it. So future years depreciation will be that much higher, which I think we would have done even in the absence of guidance. What would we do? I would believe that applying fundamental principles of accounting and the preamble also would have given us something very similar. Given that situation, this is what the government grant standard really tries to say. If the grant is received in kind, the guidance says you account at nominal value. So it could be, say, rupee 1 also. The IFRS guidance says that you should account for such grants in kind at fair value. So that is the difference between the IFRS guidance and Indian GAAP, which one could possibly note. Other than that, I don't have much to say on the government grant standard. I think it's a simple standard and it's been the same for many, many years. And I'm sure that all of us are used to it and there is nothing over controversial about it. So I will keep quiet now for 30 seconds. Wait for your questions or acquiescence or whatever I've said before moving ahead. I hope people can hear me well and you can see the Excel file and administratively things are under control. I hope. Can a few of me confirm? Can a few of you confirm to me that things are okay? Yeah, Kapil Gidwani saying okay. Thank you. All right. So I'm not finding anything, friends. So slowly let me go on to Accounting Standard 15, which largely deals with the area of employee benefits. And as I told you earlier, there have been some concessions that have been given to small and medium companies in the recent pronouncements of the MCA, which might be interesting to learn as new stuff that is happening in this area. Otherwise, first let us cover the old stuff. The heart of the standard, if I were to jump into the heart of the standard straight away, is on what we call as defined benefit plans. This is the most complex area in the standard, and this is why the standard got rewritten. Otherwise, earlier also we had an earlier standard and we were comfortable with it, but this got completely rewritten. I think it is entirely inspired by US GAAP and IFRS. And if you remember, we called it as AS15 revised because the earlier AS15 was a completely different cup of tea. And the biggest revision in this area happened, I'm sure, several years ago, but it was a thorough overhaul. So let me jump into that and let me ask you, what do you mean by a defined benefit plan? I want some responses on this, friends. It is possible that some of us know everything about this standard and some of us know nothing. It is quite possible. Even in an accounting department where there are 30, 40 people working, I have seen that this area, like gratuity valuation or leave encashment valuation, etc., is just handled by one person. And that one person knows about it, but the other 39 people out of 40 people know nothing about it because it's not their area of work. Similarly, if we are doing audits and we are in practice, some of us might know well, but some of us have not handled it at all, and we know nothing. That is possible. So can I get some definitions of what is a defined benefit plan for all of you? And if there is some other plan that you're aware of, how does it distinguish from the other plan? What does it mean? And any other experience-based or concept-based comments, please make. I'll just wait for 40 seconds silently. What do you mean by a defined benefit plan? What is the other kind of plan called? How are they different? In a commercial sense and accounting sense. Yeah, Kapil, can you address to everybody when you post a chat message? It could tell you whether you're writing to me alone or panelists alone or panelists and participants. Try and post it to everybody. That is panelists and participants.
The defined benefit plan, I think, is a plan where the benefit at the end of the plan will be given to us. That is defined, predefined. So you contribute based on what is actually required to be contributed on a monthly basis so as to get a particular benefit at the end of the plan period.
Good.
I request participants also to kindly make the session interactive. Please write to us on the chat box or the Q&A box.
Yeah, friends, I'm still waiting for some comments. Please do so. I'll wait for another 15 seconds. What is a defined benefit plan? What is the other kind of plan, and how do these two differ? Is a simple question I'm trying to ask.
The other plan, sir, is the defined contribution plan, wherein your monthly contribution is fixed, but you don't know exactly what is going to be the benefit that you will derive at the end of the plan period. Plan basically means a retirement plan.
Yeah. Okay, friends, I'm not finding much responses. Only Madam Deepa is responding, and she is part of the panelists, technically not part of the participants. So thank you, CA Deepa. Let me try and make my small comments. The $1 million question in these plans is, who is taking the risk? That I think is a question. So there is an employer or there is the employee. There is an employer and there is an employee. There is something called as a defined benefit plan on the one side. And on the other side, there is something called as a defined contribution plan. If I were to first take the contribution plan and then take the benefit plan, it might be even easier to understand. In a defined contribution plan, imagine you are the employer, take that position, it's easier to understand. I will contribute every month rupees XXX, say rupees 10,000 per month. This I will keep doing for 40 years. End of 40 years, you will get whatever is sitting in that purpose. How much will you get? I don't know. That depends on India, China, Globe, RBI, CBI, etc., etc. In the case of a defined benefit plan, the logic is at the end of 40 years of your life, working life, you will get rupees 25 lakhs. How should I, as an employer, build up this 25 lakhs? How should I make my life easy so that 25 lakhs at one go does not hit me badly? Whose problem is that? Whose problem or whose risk? So the answer is risk is on the employee in the case of the first one. How much the employee will get, he doesn't know. Risk is on the employer in the case of the second one, because the employer will have to pay him 25 lakhs at the end of 40 years or 30 years or whatever it may be. How to build that 25 lakhs is the employer's problem in the case of a benefit plan. Whereas in the contribution plan, the employer says, look, I'm contributing X amount. I have done my job. How much it will grow at the end of 40 years, 30 years, 25 years, whatever, I don't know. Don't ask me. Whatever it grows to, it grows to. If interest rates are very high and it grows fantastic, very good. If interest rates are not too high and it doesn't grow very well, bad luck. Don't blame me. I'm just putting this very small table on the screen. I fitted it into the screen properly. I want you guys to read the bullet points that I've written and ask me any questions if you have. And also debate with me if you think something I've written is not correct. So confirm, debate, argue, respond.
Participants request you to kindly respond to the speaker.
Deepa, can they also speak or they will have to chat?
They will have to chat only, sir. We have disabled everybody's video and mute mic.
All right. Okay. Yeah. What if the employee does not continue for such years? Yeah. So I'm giving you a very simple base level case, and you can have 1,000 variants of the case. The plan may not require you to stay on for 40 years. One could resign after 7 years and the risk remains the same, in the sense that 7-year risk is on the shoulders of who? That is the question. That question remains. 40 years is just an example that I created so that we get the idea quickly. that may not be necessary. I'll just go back to the table. I want you to help me based on your experience. Give me at least one simple contribution plan example and one simple benefit plan example. From an Indian point of view, what is a contribution plan example? What is a benefit plan example? From the labor point of view, you have some workers, you have some staff. Which is a typical contribution plan? Which is a typical benefit plan? India has both of them. Yeah. So the most common examples in India, I would believe, are there is this Provident Fund, where I, as an employer, am simply contributing. And what happens to the corpus of the Provident Fund is something which I don't know. Whatever happens will happen. On the other hand, if I have gratuity, I have to pay a certain amount of gratuity. Maybe there is a number, maybe there is a 15 days per year worked, blah, blah, blah formula. But the risk is on me. Similarly, if I provide medical benefits post-retirement, like for example, the railways have a brilliant scheme that after retirement, anybody who is ill, etc., can go and get hospitalized or get medical benefits under the railway hospitals. And sometimes if the railway hospitals are not capable, they can refer to private hospitals, and the entire cost is borne by the railway. Okay, now this can happen during the working service period, or it can happen post-retirement also. So those are benefits that are promised to the employee, and the risk of providing those benefits is on the employer. Now, for his own comfort, the employer may keep contributing every month or every year or whatever, or the employer may not contribute. That is up to him. But he is obligated to provide benefits. That's all. Whereas here in the Provident Fund, employer obligated to contribute. Okay, that's about it. Employer obligated to contribute. Once contribution is done, employer's obligation is over. Nothing more he needs to do. Whereas in the case of the benefit plan, employer is not required to contribute or anything. There is nothing like contribution. Employer has to come up with funds that can manage the benefit obligation. So the employer has to pay gratuity of 25 lakhs. Somehow he has to find the funds to pay 25 lakhs on the date of retirement. That is up to him. So that is the way in which we have to define these two plans. I'm happy Ravindranath has responded very well. Now we'll come to the accounting question. So between these two plans, which of them do you think is difficult to account and which is easy to account? Let us take Provident Fund and gratuity as a simple two examples. Which one is easier to account between PF and gratuity? And why? How would you respond to that? Don't give me the entire accounting scheme of entries. Just tell me which one is easier and why. I would say that if your salary cost is say rupees 2 crores per month and your contribution is say rupees 8 lakhs, then accounting of rupees 8 lakhs is very simple. Just like accounting for 2 crores. You will accrue 2 crores and you will pay 2 crores. In the same way, you will accrue 8 lakhs and you will pay 8 lakhs. Once that 8 lakhs is paid, no more accounting, no more tracking. What happened to all the retirement benefit funds, etc., is not your problem. Nothing is required. You just account for it. And end of the month, once you've paid it, there is no more accounting because you are no longer required to track the corpus of the PF. You cannot benefit from it, nor can you lose from it. You can't, right? It's not your problem. So just for our understanding, way back around the turn of the century, we had the global scam of Enron. I'm sure a lot of you would have heard about Enron and you might have followed the scam at that time, or you must have heard about it later. So this company was recognized as the world's most innovative company in 1998-99. Most innovative company in the world was Enron, and it's a great company. Even in India, they came to Maharashtra, if you remember Dabhol, and they were to put up a power plant in Dabhol, and a lot of things were happening. And they got into some frauds and went quickly bankrupt in a couple of years. That way, the US is very good in handling bankruptcy. They're very quick, unlike India, which we might take years to conclude. So they went bankrupt. Now employees lost their jobs and their careers in many cases. Unfortunately, they also lost their PF balances. This is very strange, but happened. How can you lose your PF balances, Provident Fund, I mean, they don't call it Provident Fund, they will call it 104 or something, but doesn't matter. In concept, it is the same thing. Now, how can they lose their PF balances? Because under US laws, Enron could use the Provident Fund corpus of employees to buy their own, meaning Enron shares. So the PF trust had huge holdings of Enron shares itself, which means when Enron crashed, the PF balances also crashed and employees were left with nothing because the biggest asset that they held was their own shares. So the employees really got very angry. And once they came to know, they were among the chief witnesses for the government, and they went against their CEOs and all those people who were seen to be conniving and seen to be defrauding. So the employees saw that they were defrauding not only the government or the banks or the vendors or the customers, they were defrauding the employees also in two ways. One, by making them lose their jobs, and two, by taking away their retirement corpus. Of course, nothing happened because what can you do? Once the company goes bankrupt, who's going to pay? Nobody can pay. So fortunately, in India, our Provident Fund trusts can invest very small amounts in equity. And that too is in the insurance sector, for example, your choice, how much you would like to. or let me remove that. That's a different market. But the point I'm trying to say is they can invest only very small amounts in equity, and something like what happened in Enron might not necessarily happen in India. But anyway, I'm talking about provident fund accounting. So PF accounting is easy. It is just like salary accounting, and I'm not tracking what happened to the PF funds after the month is over or the year is over. Now, whatever I've said here so far, are you guys okay with it? Any questions on whatever I've said? I want a few confirmations, friends, otherwise I'm feeling a little lost. You ask me questions is one thing, but you confirm to me, you say, okay, fine, thank you, is another. But say something, because if it's complete silence, I don't know whether people are there on the chat, they're there on the seminar, whether they're okay with what I'm saying, or does everybody know what I'm saying? Therefore, this is a waste of time. We need to know that, otherwise it's difficult for us to engage. I'll keep quiet for 40 seconds. Okay, no, I'm not getting anything. Yeah, it's very clear. Okay. Now we slowly go to the second animal here, which is gratuity accounting, which is a defined benefit plan. So there are several problems that come in the moment I get into a defined benefit plan. To begin with, let's say that I am the employer, X is the employee. If X works with me for 30 years, X will get rupees YYY as gratuity at the end of 30 years. If he leaves within 5 years, he will get nothing. If he leaves between 5 years and 30 years, he will get rupees AAZZZ to rupees QQQQ. I don't know any of these amounts. I don't even know how long he will stay. So it is a world of unknowns, so to say. There are too many unknowns here, and I have 50,000 such people. And therefore it is a universe of unknowns. This is my problem. So this year in my P&L, what is my expense towards gratuity? That is my $1 million question. At the end of this year in my balance sheet, what is my liability towards gratuity? I have very simple questions. Can I say 0? Because nobody has actually retired and is waiting for gratuity settlement. There is not a single fellow. Whoever got retired, I paid him fully. And there is not a single soul in my company who has retired and I have not yet paid him gratuity. So in that very simplistic sense, maybe the gratuity liability is zero. But in a more complicated sense, all these people are working for me every year after year after year, and because they're working for me for so many years, that is why I'm going to pay them a gratuity. So if X were to receive 30 lakhs gratuity after 30 years, it can't be fair if we charge to P&L year 1 to year 29,000 and the entire rupees 30 lakhs to the P&L of year 30. That will certainly not be fair, because the amount of 30 lakhs is being paid to him because he has been with us for 30 years. So each year of service should bear some debit. Question is, how much debit? That is the question that we need to tackle properly. So once upon a time, in the ancient past, we accounted on cash basis, more or less, which means year 1 to year 29 was 000, and year 30 was 30 lakhs. Even though I'm telling you it cannot be done or should not be done, it was being done. 50 years ago, this was the way accounting was done. Then people objected and said, this is not right. So we changed to, I'm giving you US accounting history, where history is really available in a bit. We changed to a slightly better system where we assume that all our employees retire on 31st of March 2021, let's say. If all of them retired on the date of my year ending, how much gratuity will be payable? In this scenario, in this very hypothetical scenario, how much gratuity would be payable? That is my liability. So once I freeze my liability, my P&L also will get frozen, which everybody will appreciate, I'm sure. So every year, I will assume that everybody retires. I will work out the gratuity on that assumption. Obviously, if somebody has not even spent 5 years, there will be no gratuity for them. And people who have spent more than 5 years, I will take the last drawn salary and apply the Payment of Gratuity Act 1972 provisions, and I might provide 15 days salary for every completed year of service. And then I will work out for each person what is the amount. I will work out the total amount for all my 50,000 people, and that is my liability. So if I have my opening liability last year, that is 1st April 2020, the closing liability, and the settlements done during the year, the balancing figure is my expense, which I'm sure everybody will appreciate. Let's say the opening balance liability is 100. The closing balance liability has gone to 108. Settlements during the year are 2. So what is my expense for the year? What do you think is the expense for the year? Give me some responses. Yeah. Couple is saying 10. Any other? Give me a few more responses, please. This is a numerical question, and all of us are highly numerical people. Yeah, out of 100 as a liability, if 2 crores have been paid off, then the subtotal after paying off the liability would have come to 98. And if my closing required liability is 108, okay, this is the carrying value after settlements. And the required liability is so much. So the incremental expense for the year will have to be the difference between 108 and 98, which will indeed come to 10 crore. So that is the right response from Kapil. So my expense for the year will come to 10 crore. So this went on for a few decades in the history of accounting. Then we felt this is also not correct. This is not correct in many ways. Number one, this is not correct because the assumption that everybody will retire today is unrealistic. Second assumption is many people are within 5 years today. So their liability is zero. But going forward, they may very well cross 5 years. So for these people, can we argue that their gratuity liability is suddenly rupees XXX at the 5.01th year and is zero till year 5? That is not correct nor logical. So this method understates the liability for such people because it will continue to take them as 000 till they actually complete 5 years. Even 4 years and 11 months and 28 days, 29 days, the method will show their liability as zero, but very soon they might cross 5 years and therefore the liability is not going to be that much. Thirdly, it is possible that the final gratuity, which is based on future salary, not current salary, as you will know, is far more. And we are understating that liability in this method because this is based on current salaries alone. So there was a lot of thought on this area, and a lot of experts said that we are not accounting for gratuity properly. And thus our AS 15 got revised based on the IFRS and US GAAP of those days. Whatever was there in US GAAP and IFRS of those days, we also said no, we should pick all the best principles from there. And then what AS 15 effectively says today is, what does it say? It says you need to determine your gratuity obligation based on actuarial valuations. The actuary will bring in tons of mathematics and tons of assumptions and work out the value. Value of what? Value of the obligation. And he may bring in several assumptions like, there might be continuity assumptions, or the turnover of employees, as we call it, or attrition rates, as we call it. How many people will leave? How many people will continue? Inflation rate for increments in salary. What will be the salary of these people after 5 years, 10 years, 20 years, 30 years? What is the interest rate in the country? What is the life expectancy? How long will people live? How many people may even die, etc. In some cases, there is dependence, number of dependents that you might have, or the quality of dependents that you might have, life expectancy of the dependents, not only of the main worker, but also of the dependent. Because, for example, if you take some medical assistance, etc. There are employers that provide medical assistance post-retirement for the person who worked. But after that, or even along with that, for the wife and dependents or the husband and dependents of the person who worked also. So I have to bring in a lot of that. So you determine your obligation like that. Sorry. And sorry. Based on such obligations, you derive the cost for the year, something similar to what I did on top in the example. You derive the cost for the year. As these are long-term obligations, they will be discounted at appropriate rates to come to the present value of the obligation. So please remember to do that. Of course, the actuary will do it. If you ask him to do a valuation, then he will do all of that properly. And then there can be twists and turns to these workings in several ways, in the sense that the assumptions that he considered last year may have been found to be unrealistic, and today's assumptions are different. Second is experience adjustments. Experience adjustments means that, again, those assumptions did not work out well with actual happenings in the last year. So because of that, there can be some differences in the value that I got last year and the value that I got this year. So there can be nuances based on that. So the current thought process in accounting for gratuity, or in general any defined benefit obligation, is that we have to engage actuaries, we have to do a valuation. Based on that valuation, you will understand what is the cost that you have to charge to the P&L. And this approach will take care of all these problems. That everybody will retire, we are not making any such assumptions. Even if the person has less than 5 years of service today, I will attribute some probabilities that so many people are less than 5 years, but they will continue with me for a long time, and many of them might actually cross 5 years. And if they do cross 5 years, then what will be the liability of gratuity on my shoulders? Thirdly, that the salary today is X, but tomorrow the salary will go up. And if it goes up, then what will be the gratuity based on tomorrow's salary and not today's salary? So all that will be taken care of in the valuation. We believe that the current and complex method of valuing these gratuity obligations is probably the right thing to do, even though we have not been doing it for several decades absolutely properly. I will now pause here, wait for your questions and comments before I move ahead. Yeah, Kapil Gidwani saying okay to move on. I have how many participants here now? I have 69 participants. Can I get a few more comments, please? Okay. Now there is also, when we do all these things, there is, I would say, tons of disclosures around it, because there is so much of work that we are doing, and therefore these are pretty long notes that will come in the accounts, describing all that we did and the assumptions, demographic assumptions, financial assumptions, etc., etc., etc. Related to this area is what we call as plan assets. So what do we mean by plan assets? What are plan assets in this case? Again, let's say you have a gratuity scheme. You are appointing the actuary, and actuary comes up and gives you all these obligation related numbers. He adjusts based on last year to this year, blah, blah, blah. Everything is done. And then there is a story called plan assets. What do you think plan assets are in this context? What will the actuary do here? How do we handle it? What is your understanding? How can you have a plan asset? What is a plan asset? In this context, I think CA Deepa already explained to us what a plan means a few minutes ago. Yeah, by some fixed contribution. Okay. Anything more? What do you mean by a plan asset? Okay, so most companies are, most companies are terrified with such obligations because in some future year, they need to come up with tons of cash. And if they don't have cash at that time, then they get into a lot of trouble. And employee benefits are such that you cannot actually pay it on. It's not like a vendor that you can tell him by come tomorrow, come day after, etc. Is not possible. So prudence or financial prudence, not accounting prudence, financial prudence demands that you set up a corpus which will help you to discharge those large liabilities when they come up. So what people will do is they will set up some structure. They will set up some structure through which such liabilities can be funded properly. It's a funding game. For example, some companies might set up a gratuity trust. Some might tie up with LIC or other insurers. Some might just keep aside funds privately. I would say more informally than formally. Depending on how large you are and what kind of governance structure you have, and do you have independent directors and you have risk committees or not. It depends on many factors. The law, to the best of my understanding, does not force you. It's more of financial prudence that overrides such considerations. Now, if there are clear assets that are set out separately, then these become plan assets for accounting purposes. And most of the time, the third one will not qualify. You've just put in money in the bank and you've just kept it separately. That is just in your mind. You have not made any legal allocation. Then those will not be plan assets, but these two will be plan assets. So the first two, I'm giving you Indian common experience than anything else. So if you have these kind of amounts, then these are plan assets. So at the end of the year, if your defined benefit obligation, DBO, is say rupees 100, and your plan assets are say rupees 88, then you are allowed to offset these two as per the standard AS 15 and present a net liability of rupees 12 in your balance sheet. Offsetting assets and liabilities is not generally allowed, but in this case, this is allowed because this relates to the same area, namely gratuity, and you are going to manage your liability or obligation of 100 rupees with your plan assets of 88 rupees. So that is allowed, and a net presentation is indeed allowed. Secondly, when you charge gratuity cost to your P&L, the income that you earn from your planned assets is netted off against this cost. Okay, otherwise, in general, such incomes go where? Such incomes like interest, for example, would be classified as other income. In your P&L, normally, if you are a manufacturer and you earn some interest income, that will be classified as other income. But here it will not be classified as other income. It will be set off against gratuity cost because this is essentially to manage your gratuity liability. So that offset is available. I'm sure many people would like that offset, especially if I'm doing some ratio analysis, etc. I may not want an asset shown separate and a liability shown separate for the same story at the background. Similarly, I might not want other income in my P&L at all. I would be quite happy to offset it against my employee salary cost. So these are available under the guidance in the standard. Now the standard is a little more complex. Now I'm not very sure how much I should get into technical details because I'm not getting a good feedback from you guys. If I get some high quality questions, I will dive deeper. But if this level is okay, then I will not dive deeper, depending on how we choose to structure this discussion. Is the level at which I'm talking okay? Is it too simple, too difficult, or just about optimal? Can you give me some sense? Yeah. Jayam is saying simple. Jayam, post to everybody. You're writing to me privately, but if you post to everybody, then people will know what you're saying. Yeah. Is anybody uncomfortable with whatever I've said? Anything that needs any elaboration or clarification anywhere? Kapil is saying simple. Jayam is saying simple. Anybody else wants to say something? No. Yeah. Okay. So let me talk about a couple of areas which are slightly away from what I've said so far. And why do they arise and how does accounting handle it? Let me try and help you with that. So there is an area called actuarial gains and losses. Actuarial gains and losses. So what does this actuarial gains and losses mean? Let's say there is an opening balance of gratuity obligation of say 500. Additional, or let's say that this is the obligation. Now there are settlements during the year. So people retired and I paid them gratuity, or they resigned, I paid them gratuity of say 40 crore. Now, during the year, actuaries have come at the end of the year also, and they have kind of told me that the service cost for the year, in this year people have worked and therefore some gratuity accrues for the year, and that service cost for the year is say 48. And there is an interest cost for the year. I will explain to you what this interest cost and service cost actually means in little more elaboration very shortly. It's a 30 crores for the year. So the arithmetical total of all these above numbers is coming to 538 crore. So this is my opening balance. This is settled, means I cleared up that much of liability. So my liability comes down. This is accrual for the year. There is more liability because people work for one more year. And there is interest cost for the year because I'm going to pay them later on. So all long-term liabilities by definition have an embedded interest cost. Okay, which I think everybody will understand. In fact, Ind AS makes this compulsory. Any long-term liability you record in your balance sheet has to be discounted to present value. In our old Indian GAAP, sometimes we did, sometimes we did not, but at least in the area of gratuity, etc., we have always been doing it. Which means, in simple words, if I need to pay Mr. X rupees 1,000 after 5 years, the present value of that obligation is not rupees 1,000. Maybe it is only rupees 700. And this 700, I will increase year after year by attributing some interest cost to it so that it grows to 1,000 in 5 years' time. That, I think, is the basic philosophy of discounting. So this process is called undiscounting. Undiscounting means I am taking the 700 and slowly bringing it up to 1,000. That process is called undiscounting. So if I say that there is year 1, 2, 3, 4, 5, and there is an opening balance of say 700, and I charge an interest accrual on it, okay, and this is called undiscounting. Let's say 700, I increase it by 40 rupees. So the closing balance goes to 740. And that 740 is the opening, and I increase it by 45 rupees, and that goes to 785, and so on and so on. And slowly the idea is that this 785 or whatever it is has to go and reach 1,000 at the end of year 5, because that is what I'm actually going to pay as I estimate today at the end of 5 years. So this process is called undiscounting. And in that process, what we will do is two things. First, we will present value the obligation. Second, we will undiscount the obligation or add to that obligation or accrue interest on that obligation slowly so that it reaches the target figure of 1,000 at the end of 5 years. That is what this interest cost is, undiscounted. Now the arithmetical total has come to 530. So in a simple world, the obligation, let me use the word obligation, which is more correct, should have been rupees 538 crore at the end of the year. But our actuary comes to us today and says, sir, your obligation is 552. Now, how does 552 come about? From where has this come? I have done absolutely correct tracking of all the numbers, and I have not made any mistakes. The opening balance was indeed 500. I settled 40 crores, so that came down. For the current year, I have taken the accrual based on the actuary numbers only, not my own numbers. 48 crore of service cost and 30 crores of interest. And the total should have been 538. But he says, no, it's not 538. It is 552. How can 538 suddenly become 552? Is he actually making a mistake? Or are we making a mistake? Or is it something deeper? What is the problem here? How do you think we should sort this out? So this is largely because of what I told you earlier, two factors or two reasons. One, the assumptions made for opening balance and those made for closing balance are different. They're actually the same. But last year he thought long-term inflation will be 5%. This year he's saying, no, I think long-term inflation will be 4.9%. Those kind of differences. And the assumptions made for opening balance and those that got crystallized during the year are different again. So the opening balance assumptions will have two implications. One is all the settlements during the year, whatever we thought will happen did not happen that way. It happened in a different way. And the second is whatever opening balance issues are still continuing in the closing balance, but the assumptions have changed. That is again making some difference. As a result of which, the new obligation of rupees 550 crore is a right obligation. And I need to account for this extra in my books this year. So give me two answers. How much extra and what journal entry should you pass? And just do this logically. You don't need any rules or standards for that. This is just, I would think, logic, simple logic. Simple logic. What journal entry would you pass? Debit what, credit what, and for what amount, and why? Yeah. Kapil is giving me a response. Can I request others also and Kapil also? Which of the four will I debit or credit? Asset, liability, expense, and income. Out of the four windows, which one should I hit? Yeah, everybody respond in the chat box. I'm not looking at the questions and answers box at all. Just post on the chat box. Yeah, debit what and credit what? Yes. So the extra is rupees 14 crore, I would think, friends. Because 552 is my required obligation. I already have 538 in the book. So another 14 crore I will have to account for. And I will debit gratuity expenses because I have to increase the liability. And that will go to the P&L, obviously. and I will credit gratuity obligation, which is a liability. This is a journal entry that we will be required to pass if we follow Indian GAAP Accounting Standard 15. This is what Accounting Standard 15 asks you to do. And this is an actuarial gain or loss. In this case, this example is a loss because my liability is actually going up. So it is a loss and I'm booking the loss as an expense in my P&L. Okay, obviously in some other cases, the liability could have come down also. If the final liability instead of 538 is something below 538, then it would be a gain. And that gain, if any, will also go to the P&L, in which case it will help my P&L. It will reduce the cost and increase the profit. But in this example that I've created, this is increasing my cost and reducing my profit. Is this entry okay? Are we comfortable with what I'm saying? Any questions? There is a similar actuarial gain or loss possible on the plan assets side also. So let me give you a very small example of that, and then maybe we will have a break and come back. So let's say on the plan asset side, I had an opening balance of say 400 crore. And the further contributions to this plan that came in during the year from the employer were another 40 crore. So let's say there was a subtotal of 440 crore. But there were some settlements done during the year. When settlements are done, I have to pay. When I pay, the amount paid will be the same as what I've taken in the earlier example. It's the same company. So whatever 40 crore, I'm sorry, I made it 40. Let me make it 35. So the figures are slightly different. So now I have 395 crore with me. And I planned for planned or estimated returns on investments. Investment means all these plans was, let's say the actuary said we will earn 6% on it. So on 395 crore, if I earn 6%, that is 23.7. So my closing balance should have been 418.7. But the actual fair value of planned assets is, say, rupees 425 crore. Let's assume that. Now, what has happened and why? What is the nature of this story? What has happened? Why has it happened? And how should I do the accounting for this phenomenon? Is it a gain loss? What is it? And how do I understand it? What is the accounting entry we will pass and why? And what is the commercial background of whatever story I have painted before you here? Yes, friends. Based on prudence, should we account this? No. The standard says very simply, you have come up with an asset working of 418 crore based on your estimate of planned returns or estimated returns or expected returns on plan assets. You thought that you will earn 6%. Now, in reality, you earn more. So this 6% was an actuarial assumption made in the beginning of the year where the actuary said, oh, all on my investments, I will earn 6%. On that basis, he gave you whatever guidance, etc. But in reality, you earn more. How do you know you earn more? Because you have a higher asset base than what you thought. So this difference between estimated returns on plan assets and actual returns is another form of actuarial gains and losses. So actuarial gains and losses can come in two forms. One is as relevant or applied to DBO, defined benefit obligation, and as applied to plan assets. So what we will do is we'll recognize this gain. We will debit plan assets in this example by 425 minus 418.7. And we will credit gratuity cost or gratuity expense. It is a gain, so it will reduce the expense because I'm going to credit that expense. It will reduce the quantum of the expense. So this is an example of actuarial gain. The earlier one was an example of actuarial loss on the DBO going up. So both aspects put together, if I summarize, there is an actuarial loss on the defined benefit obligation. There is an actuarial gain on the plan assets. So net, whatever it is, it is. So let me see what was the figure earlier. In our example, we had taken a loss of 14 crore. Okay. So I'm making that negative for us to track it better. And there is a gain of 6.30. Net, the actuarial gain or loss for this year is 7.70 loss. So under Indian GAAP, under AS 15, this net actuarial gain or loss is taken to P&L. So in this example, I will record an incremental net expense additionally of 7.7 crore because it is simply part of my gratuity expense. And the gratuity expense obviously hits the P&L. That is the background. Just for our information, under IFRS or Ind AS or even US GAAP, such gains or losses are not taken to P&L. They are taken to reserves called other comprehensive income in those accounting literature, and it is not taken to P&L. But Indian GAAP still takes it to the P&L, whether it's a gain or a loss, it will simply go into the P&L. So I think with this discussion, friends, I have completed my bit on how defined benefit plans are accounted. And in particular, I have elaborated slightly on actuarial gains and losses, which is, I think this is the heart of the standard. The rest of the standard is all, I think, very, very simple and straightforward. So I'm not laboring on them. But defined benefit plan is the heart of the standard. And I've kind of covered the actuarial valuation, And the plan assets, defined benefit obligation, the actuarial gains and losses on the liability side as well as the asset side, and the net and how the net is finally accounted. So I want to pause here for 30 seconds. If there are any questions on what I've done on AS 15 so far, I will take them up and then we will go for a break. Okay. So I'm not finding any questions from you guys. I'm therefore announcing a 10-minute break. Time is 3:38. Let's come back by 3:49 or so. Thank you, friends. We were discussing the AS 15 revised standards. And by and large, I've told you the heart of the standards. We covered DBO, plan assets, actuarial gains and losses in some depth. I would believe that the crux of the standard remains the same for small and medium companies also. It does not substantially change anything. It remains the same. However, a few concessions have been granted in the new standards, in the SMC standards, as all of us will be aware, and some of them are, I think, useful. So we will try and go through those concessions. I will not dive deep into them because we are, I don't think we have enough time to actually dive deep into them that much. But I have made a list here, and so anybody is interested in, anyway, this list is going to be there with you. So you need not worry. You can go back and refer the list, and when you're actually applying it in practice, if you need to apply, the list I think will be useful to you. So I'll go through this very quickly. The SMCs need not comply with paragraphs 11 to 16 to the extent they deal with non-vesting accumulated absences when cash is not to be paid. So what this means in very simple words, this is not the DBO area, this is general standard now I'm going back to. And what it means in simple words is that if you are granting, say, sick leave to your employees, and this cannot be encashed, this can only be carried forward for 1 year, which is called short term, okay? Then there is no accounting required for such sick leave if you are an SMC. That I think is the practical aspect of what this particular concession is trying to tell you. Of course, if the sick leave can be encashed, you need to account for it on the date on which the services are rendered, which remains the same as earlier. But if you are an SMC and you're not giving them encashment, you're only giving them compensatory leave, then you need not account for it. Second is para 46, which says, which is again, I think, a very rare event. If you have to pay Provident Fund, if your contribution to Provident Fund is due after 12 months, then you don't need to discount this liability. Normally, anything after 12 months is discounted. But if there is a contribution to Provident Fund due after 12 months, which is already accrued, okay? So this is impractical because I don't think that Provident Fund laws allow you to do so. Provident Fund laws allow you to pay only in the next month. You can't pay later. If you pay later, there are lots of consequences, both from Provident Fund point of view and from income tax point of view. So this is a very theoretical concession. So I don't think we need to spend too much time on it. Now there is para number 116, which says that the detailed guidance of defined benefit plans, which is where we spend most of our time today, from paragraph number 50 to paragraph number 116, is not applicable to our small and medium companies. Instead, what they can do is they can apply actuarial unit credit method and must discount their liabilities. Now, in practice, the paras 50 to 116 also say the same thing in effect. They also say that we will apply the actuarial unit of valuation and they must discount their liabilities. So I personally think nothing much will change because you have to still do the same thing as you were doing earlier. Maybe what may change, what will change, which is covered in the next exemption, but I'm preempting it, is the quantum of disclosures around it. So earlier, probably we used to disclose tons and tons of stuff, detailed DBO working, detailed P&L debit, including, for example, we used to say how much is our service cost, how much is our interest cost, how much is the actuarial gain or loss, all those disclosures, etc. These go off if you are an SMC. But the heart of the substance of the concept is the same, and I don't think there is any major difference there. So if you look at the this disclosure, that is para 126, this is what I've written up. This is detailed disclosures of defined benefit plan that do not apply now. So this is refer point 3 above. Both of them put together say what I'm trying to say. Then there is another small exemption which says that, we have DBO liability and plan the assets as assets. These can be offset, as I told you earlier, but SMCs may or may not choose to do so. So even if they don't offset and show them separately, it is okay from a para 118 exemption point of view, which I don't think is a big exemption. Again, doesn't change the reality of the accounting anyway. This is very obscure. If there are any other long-term benefits, not retirement, but long-term benefits, there also it says you need not do the elaborate para 129 to 131, but you can apply actuarial unit credit method and discount the liability. This is same as retirement benefits. Whatever concession they have given is to maybe reduce the hard work, but in substance, you will still do the same thing. And the final concession is para 139, which says termination benefits beyond 12 months need not be discounted if you are an SMC. Termination means I've actually terminated somebody, I've asked him to go, and the liability for him is partly stretching beyond 12 months. So normally these would have been discounted by normal companies, but if you're an SMC, then you need not discount. That is, I think, the benefit given in this area. So while the number of benefits given appear to be fairly high, in reality, I don't think there is much benefit for the SMCs because they still have to do an actuarial unit credit method. They still have to discount their defined benefit plans. Maybe there is some benefit in not disclosing as much elaborately as they did before, but at the background, they will have to keep all that because only then your accounting will be correctly done. These are just some of my notes, which I can probably just go down and move further. I will, if all of you agree with me, I will slowly go to AS11 and the guidance note related to the topic. But I will wait for 40 seconds and ask you if you have any questions before going further. So let me just mute myself for 40 seconds. Yeah, friends. Anybody with any comments or questions on the two standards that we have discussed so far? All right. So we go to AS11, which is a fairly old standard, and it lays down very basic accounting principles. I would believe that it deals with number one, accounting of transactions. Let me call it transaction accounting. Then there is translation accounting. Then there is forward contracts. These are the three areas that AS11 seeks to address. And the guidance note seeks to address forward contracts of the types not covered by the standard. Other derivatives that are non-forward contracts, like for example, if you have swaps or options, etc., that are not covered by the standard at all. Something on hedge accounting, hedging, and how accounting of that should be done. And there are some other matters that I'm not getting into because we will not have time even to discuss whatever we have listed above. So I will slowly go into each one of them slowly and then cover them. And as I speak, if you have any questions, I will be happy to take them up. So let's start with transaction accounting. In transaction accounting, let's build an example. You are an exporter and you exported US dollars 1 million of goods today. The customs USD INR is rupees 75.57. The RBI reference rate is rupees 75.25. The SBI bid and ask rates are rupees 75.09 and 75.32. You collected the amount from your customer on 13th of January 2022. On that day, spot was rupees 76.00, and you got your money on that basis. Tell me, what is the accounting today? Give me a journal entry, give me some numbers. Debit what, credit what? Friends, I need a response, please. Yeah, friends, how much do I debit? What do I debit? What do I credit? On what basis? Do you think? Yeah. So I have one response. Let me try and follow. I will debit trade receivables and I will credit sales revenues. Question is at what rate? So the standard only says at the spot rate of the day. It does not then go on to provide you detailed guidance on what you do. So I'm giving you a little bit of practical stuff. Companies will need to make their policy on this subject on how they would like to work it out. And in reality, we apply various policies. We don't use the customs rate because that is not reflective of the market at all. Some companies apply the RBI reference rate, which is published every day. Some companies apply the Bloomberg closing rate because Bloomberg is a very commonly accepted system. And some use the SPI rates. And even within here, if you have 2-3 rates that I'm telling you, we could account at either bid or ask, depending on which side you are, or apply a mid rate. When you have multiple rates available, you could apply a mid rate, which is an average between the two. So supposing somebody has said bid, BID. So let me try and understand what this bid rate means and how that might work. So what do you think the bid here is and what is the ask and what does it mean? And if I'm an exporter, which rate is relevant for me? Can you help me with some background on that? I'm not using this rate, customs rate, as I told you, that's not market. RBI can be used, one possibility. SBI also can be used, but in SBI, there are two possibilities. Either I use a mid can be the average of these two, or I use one of these, bid or ask, whichever is more relevant for me. So my question is now twofold. What do you mean by bid? What do you mean by ask? And second is, as an exporter, which rate do you think is more relevant for me? Can you help me with some comments here? What is bid and ask and how is it relevant for an exporter? Can you help me write some comments? It's okay. You can write long comments. The chat box can take it all. Don't worry. Okay. So friends, if you use the RBI rate, obviously there is only one rate, so you'll apply that. If you choose to apply the SBI rate as an exporter, you will be selling dollars to them and they will be buying dollars from you. Okay, so when they buy, they will pay you the lower of the two rates. Please remember that. I think commercially, if you understand that, it will be easier. Out of the two rates, if they have to pay you, they will pay you the lower of the two rates. So the lower of the two rates in this example will be 75.09. So they will only pay you 75.09. So that will be the bid that will apply to you. So either you follow the SBI bid or you follow the RBI. So if you follow the RBI, then you would take 75.25, or if you follow the SBI part, then you would take 75.09, or you can apply the SBI mid, in which case we will say 75.09 plus 75.32 divided by 2, in which case it will be that rate. All the three are possible in the market. The standard is not restricting you or prohibiting you from any of these rates. As I said, even Bloomberg rates are used. I'm not using that example because that will be just a repetition of this one. So it can be RBI reference rate, it can be SBI bid rate, or it can be SBI mid rate. All the three are possible. I will request you to post your agreement on that, say yes or okay or something, so I can go. Now, what will happen when you collect your money? What is the entry you will pass on that day, which is on 13th of January 2022? What entry will be passed? Debit what, credit what? And how do we reconcile with the earlier entry that we've probably passed? Collection entry will be driven by what I have chosen as the accounting policy. Supposing I've chosen the RBI reference rate, then the collection entry would be bank debit 76, because that's the data that I'm giving you. And trade receivables credit, whatever I'm telling you here, 75.25 have gone for the RBI reference rate. And there'll be forex gains which will go into the P&L, which is 0.75 in this example. And the same for other possible day one choices of rates. So obviously the choice is not RBI, it is SBI. Then the gain or loss may be slightly different, but the logic will be the same. Now I want to bring in another angle. What if you are making a proper balance sheet on 31st of December 2021? Supposing the quarter ending comes and you want to make a proper balance sheet of that, and on that day, the RBI reference rate is say 75.91. SBI bid is 75.72 and SBI ask is 75.99. Okay, take all these possibilities and give me some accounting entry. Let me hide these rows. You have passed possibly 3 accounting entries on the day of inception of the transaction. And then now these are 3 possible data points on 31st of December. What is the journal entry you will pass on 31st of December is my question. Take 60 seconds, 1 minute, and give me some numerical answers. Yeah, friends, give me some responses. What is the accounting on 31st of December? So the conceptual point is that the trade receivables will be revalued based on closing rate of 31st December, obviously, because that is the date we are talking about. And difference will be taken to P&L. So if I take the RBI reference rate as an example, then the entry I will pass will be trade receivables debit and forex gains credit. And the gain is 75.91 RBI reference rate on day one today minus the rate on day one. And that difference happens to be 66 paisa. So I will record a higher trade receivable and I will take the gains to the P&L of 66 paisa on the 31st of October. Similarly, for the other situations also, something similar will be done. I'm not repeating that because it will be the same logic. Can I seek your confirmation on this treatment? This is commonly called revaluing monetary items. That is the term that we use. This is the monetary item, the trade receivable, and I will be revaluing at the closing rate on that day. What is the closing rate? That depends on my accounting policy. It could come from RBI reference rate, SBI bid rate, or SBI bid rate that I already discussed in the context of day one accounting here. Is this looking okay? Can I go further? Now let me try and bring in the forward contract into this example, because I think it is better to learn through examples rather than through paragraphs of the standard. What if we entered into a forward contract on 13th of October 2021, wherein we sold USD dollars 1 million for 3 months forward at say rupees 75.87. We sold that forward at 75.87. Let us assume we follow the RBI reference rate for our accounting. We follow the RBI reference rate for our accounting. What do you think will happen now? Meaning, on day one, which happens to be 13th of October 2021, what is the accounting for the forward? Let's start with that. We have a sale of $1 million. We made our invoice. We recognize that at the spot rate. Spot rate on that day was 75.25. All that is fine. And then we also did a forward at a rate of 75.87. So on 13th of October 2021, what is the accounting for the forward? Take a minute, friends, and tell me what is the accounting. Give me some response. Yes, friends, give me a response, please. What is the accounting for the forward on day one? You enter into a forward contract. What is the accounting on day one? What will you debit? What will you credit, friends? Could be, Jayam. I don't know. I'm asking. What is the premium on the forward contract, and will you debit that or credit that, or what do you debit? What do you credit? What is the amount of premium? How do you quantify the premium? Okay. The simple answer is there is no accounting on day one. There is nothing on day one because no asset, no liability, no expense, no income is created on day one. A forward contract is merely or is like a purchase order. And it's like a purchase order. What does a purchase order do? It obligates one party to provide goods, as an example, or services, and obligates the other party to pay. So what accounting do we follow for issue of purchase order? If I issued a purchase order today, what is the accounting? And the answer is no accounting. No accounting. In a similar way, this forward contract obligates you to, I would say, sorry, this forward contract obligates you to hand over $1 million to the bank on 13th of January 2022 and obligates the bank to hand over INR, how much? 75.87 is the rate that you have agreed. 75.87 million to you on 13th of January 2022. That's all the forward contract does. It says, Baba, you hand over $1 million and the bank will hand over 75.87 million rupees. This is a two-way obligation. and therefore there is no accounting for a purchase order. What does a purchase order do? Purchase order obligates you to pay and the other party to supply goods or supply services. Exactly the same thing is happening here also. But the difference here is from tomorrow onwards, this forward contract fair value will start moving up or down depending on where the USD INR moves, which is a constantly moving thing. The value of the forward also will go up or down. So if you wish to cancel the forward, say after 4 days or 4 weeks or 40 days, you will find that either you have to pay the bank because the rate has moved against you, or the bank will pay you because the rate has moved against them. One of the two will happen. This is called fair valuation gain or loss. This is sometimes called MTM or mark to market. Those are terms that we find in the world. AS11 doesn't say exactly that. In a way it does, in a way it doesn't, but I'll try and help you slowly with what AS11 says. But the first point is that there is no accounting on day one, and it's only an obligation, and it obligates both parties to do whatever they are supposed to do. Now, what does AS11 say about subsequent accounting, subsequent recognition, subsequent measurement? What does AS11 say about that? Number one, it says you have to tell me whether you are hedging or not. If you are hedging, the accounting is done in X manner, and if you're not, the accounting is done in Y manner. So there is a difference between your hedging or not. If you are hedging, then A, you amortize the forward premium over time. B, you revalue the spot element of the forward at every reporting date. So these are the two things that our standard is telling us. Now, some of it may be clear and some of it may not be clear. So I will take our example and run with it and try and explain to you how accounting can be done. In this example, how much is the forward premium? That is the first thing to be understood. So the spot rate on that day, on 13th of October, when you actually entered into the forward contract, the spot rate of that day was what? And we have chosen the RBI rate, so we will go by the RBI rate on that day, which happened to be 75.25. And what is the forward rate that you have agreed for a 3-month forward? And the answer is 75.87. That is the forward rate that you have agreed, which I have given you here as a matter of fact. You have sold your forward at 75.87. So when the spot was 75.25, you agreed to a forward rate of higher. So the premium in this example will be this difference, which is 0.62. And this premium will be amortized to P&L over time. So if I try to apply time on this, I might say October, November, December, and January. 31 days minus 13 days is 18 days. November is 30 days. December is 31 days. And January is 12 days. The 13th of January, it will open up. And this is 0.62. So the premium, if one were to amortize, will come to so much every month. So this will go to income every month. So all these three, October, November, December, 3 months is my quarter end. So if I take the total of these three numbers till December, I will find that I have an income of 0.5382. This will be taken to income because I've sold the forward dollar and I will get premium income on it. So the journal entry will be forward contract receivable, because that premium will be received when I actually settle the forward contract, which is an asset for me. I will debit that asset and I will credit forward premium income, which is a P&L number. It will go into the income in the P&L. So this is one entry that will be passed. Amortization of the forward premium over time to the P&L. Now I want to pause here for a minute, take your concurrence that you're okay with what I'm saying. So I'll just keep quiet for 30 seconds and then move on. So I have one okay from Kapil Gidwani and the majority is fairly silent. I will move on. Jayam is saying okay again. So now the second aspect of AS11, which few people observe, is as under. And the second aspect kind of offset itself, so many people don't observe. The first part is that the underlying trade receivables are revalued anyway, as we discussed above. So the entry that I'm going to pass is that there is trade receivables debit to Forex gains. And we already passed that entry for, I think, 66 paisa or something, which is an entry on the underlying. Underlying means underlying monetary asset or liability, as the case may be. So this entry, if I pass, the second part is the forward contract conceptually can be broken down into two elements. A, there is the spot element. Within the forward, there is a spot element. And B is the forward premium or the forward points. So for example, on day one, the spot was 75.25, but the forward rate was higher. So the forward premium, we got it to be 62 paisa. So 75.25 plus 62 paisa is what made 75.87 anyway. Now, this is revalued. That is what the standard says. And this is amortized, which means you have sold this forward. Having sold the forward, you have to deliver on 13th of January 2022. So if you have sold something and the value of that drops, you will gain because you can buy it back for a lower price. So let us say that you sold an elephant for rupees 50 lakhs and then delivery is after 3 months. And in the meantime, elephant prices have dropped to say 43 lakhs. You could buy a new elephant at this 43 lakhs and deliver and gain rupees 7 lakhs. Okay, that is the argument that if it drops, then I gain. And if the price rises, then you lose. Because if you sold something and you have to buy it back at a higher price, obviously you will lose. And the price today of the spot element on that day, that is 31st of December, as per the RBI reference rate, in my example, has gone up, and it has gone up to 75.91. Same price that we use for the revaluation of the underlying asset. But when I'm talking about the forward, it becomes the reverse, and there is a loss of 66 paisa, which means the accounting entry will be, there is a forex loss on spot element of forward, which I debit 66 paisa. Let me pick up the figure from here, so the connect is okay. And there is a forward contract liability of 66 paisa, meaning if I were to cancel the forward contract today, I might have to pay 66 paisa to the opposite bank. So as a result of both of these things, what is happening is that you record a gain of 66 paisa on the underlying trade receivable, and you record an identical loss on the spot element of the forward. The two will offset each other because one is showing a profit and one is showing a loss, and that is exactly the way it will always be. This will always be like that. So net, the only entry that is left in the P&L is the forward premium amortization. Nothing else is left. So that will be that will smoothly flow into the P&L over time. One can even think of it from a very simplistic point of view that on my trade receivables, I face a USD INR risk. If it goes up or down, I will lose or gain. To hedge this risk, I entered into a forward contract. And if the dollar goes up, compared to the rupee, I will gain on trade receivables and lose on the forward. And if the dollar goes down, I will lose on trade receivables because what is going to be received will be lower than before, but the forward will help me. Net, these two will get offset. And because these two will get offset, what is left is the premium, the difference between them. Income for exporters because the dollar is always at the premium, and expense for importers because when they book the dollar forward, they will have to pay that premium. So that is an expense for them, and this is an income for them. Now, AS11 says exactly what I'm saying, but I've not found people by and large doing the second and the third entry at all. It is more or less understood, or sometimes people don't understand, but they simply account for the premium, and that is the end of the day, only entry that gets passed. So this is, even if you just pass this entry and don't pass the other two entries, it's okay. God will take care of your P&L, and the P&L will just get this income, and nothing more needs to be done. That's the way in which the transaction accounting on day one, on settlement day, and on quarter end can be understood. Along with that, if a forward is covering your export receivables, this is the way the accounting can happen. Now I want to pause here. If there are any questions, I'd like to take them up. Okay, there are no questions. The third situation is what if you enter into a forward, but it is not for hedging? There is no hedging to do. It is for trading or speculation, as we call it. Then what do we do? And the answer is AS11 says no amortization of the premium or anything. Simply revalue the forward at quarter end or year end, whatever it may be, and recognize the gain or loss in the P&L. So if I were to maybe build the same example, you sold this forward at 75.87. You sold this forward at that rate, I'm sorry. On 31st of December, this forward had a market rate of 76.01. Okay, don't worry about premium, etc. If the value of the forward goes up, that is a loss, because if I were to buy back at 76.01, obviously I will make a loss. So you will book this loss in very, very simple words. You will say, okay, I entered at 75.87. Right now, if I square up, I have to pay 76.01. So there is a loss of 14 paisa in this deal. So I will say Forex losses, debit 14 paisa to forward contract liability. If I were to square up the contract on this day, today, I will have to pay the market or the counterparty 14 paisa. That is I think the understanding. And on that basis, I will have to record the loss and record the liability. And this is the way accounting will be done if you are not hedging. So if you are hedging, I showed you the entries. If you're not hedging, I've showed you the entries. Yeah. First, I told you have to tell me whether you're hedging or not. If you're hedging, then these are the entries. And if you're not hedging, then these are the entries. All this is written in AS11 itself, friends, and this guidance of AS11 has been with us since, I think, since a few decades. It's been there. But it is quite simple and possibly simplistic in the sense that it does not cover many areas. So what do I do if I hedge forecasted transactions? Meaning it means that I will export $20 million of goods in the year 2022. I enter into a forward for these sales. What we have to understand is there are no trade receivables today because I have not even exported. But I will export next year, and for that I want to hedge. Or for example, I have a dollar loan. I want to hedge the principal. Or I have, I will have a dollar loan is also possible. That is forecasted transactions. But let's say I have a dollar loan, I want to hedge the principal. Or I have a dollar loan where I pay interest on LIBOR. Based on LIBOR, I want to hedge the interest. Okay, so there are so many such possibilities where we could use other instruments like options and swaps and etc. This accounting is not covered by AS11. It is covered by, in the India space, it is covered by Ind AS 109, which is of course a much more bigger standard. So for Indian GAAP, the institute has come up with a guidance note. And this guidance note has also been revised from time to time. Our latest guidance note is available, 2021 version. I would request you guys to maybe go through the guidance note in some detail. I will not have the time to take it up here, even though I thought I might, but I don't think it will happen. So that guidance note, I think, is very interesting and it's very technical. Then AS 11 also deals with translations. Translations means you have subsidiary abroad or any other associate abroad, etc. So how to convert their trial balance into rupees and consolidate their financials with our financials. That is a question that we sometimes face challenges in. So there is some detailed guidance on the subject, including integral and non-integral operations. We would have done this in our studies, I'm sure, in our inter-CA and final CA, as well as in our practice from time to time. There has been no change here since decades or something, so there is nothing new that has happened. Of course, your Ind AS 21 comes up with a different concept altogether. Instead of the concept of integral and non-integral, there is a concept of functional currency. And that, I think, is something beyond the scope of our discussion right now. I'm just giving you for background information. But otherwise, whatever we were told in our studies in inter-CA, final CA, I'm sure the same thing is continuing even now. In very, very simple words, if you have an integral operation, then the forex gains or losses will hit the P&L. And if you have a non-integral operation, then the gains and losses will hit the reserves. I think that is the sum and substance of the guidance, the crux of the guidance. Okay, let me just put that down. What we call as foreign currency translation reserve. That is where it will go. And there is a lot of logic and philosophy behind whatever is suggested and why it is suggested. But I think we will not dive deep into that. So I think with that, I have completed the discussion on AS 11 also. I've saved this file. I will mail this file to CA Ranjit at the end of the session. Any last minute questions anybody has, please raise them and then we will wind up.
Friends, if you do you have any doubts, please raise.
Okay, so friends, thank you very much for patient listening. I hope this was useful for you. I will now request CA Ranjit or CA George Verghese to take over. Thank you.
Sir, will you put on your video, sir?
Yeah, I have done.
Any queries, any questions? I think at the last time, I think it's the last minutes, you can raise the questions or queries. It was a wonderful presentation. I think all the three accounting standards, I think you are in fact taking a class just like a workshop, explaining everything through examples, and really the way you took class, particularly through Excel, explaining through Excel, not only the examples, but also the silent features also you were explaining through the Excel. It was a wonderful way of listening as well as reading.
Thank you.
I don't know why, because normally the members might be listening through mobile. That may be the reason why the response is much less.
Okay. Oh, okay.
It's because of I was using laptop. It was easy for me to go through your
Right.
presentation. Very easy. It is.
Oh, okay. Okay. Hmm.
So it is not because of any other thing, particularly because of this mobile.
I understand.
It is an excellent presentation. I think I do feel. I think because all the three, particularly this actuarial valuation as well as your this foreign exchange that earnings or loss, whatever it is, all the accounting, all the statements. It was very easy to understand and learn. I think so. It was very nice of you. We don't know how to thank you, sir, for the excellent presentation on behalf of the Ernakulam branch. We express our heartfelt gratitude for your excellent presentation today, and we hope we will have you in a physical meeting in the near future. I think so, sir.
Sure.
Friends, I
Thank
think
you.
the last 3 days we had a wonderful refresher course with the help of Accounting Standards Board of India, ICA. That is 9 accounting standards we covered, taken by experts in the field, ably supported by the Accounting Standards Board. And we had with us MPV sir on the first day, and throughout all these days, Vaishali madam was here and still she is there, and it is great motivation. I request Chairman to make a concluding remarks, please. Chairman. Over to you, Chairman, please. Chairman, can you hear? Oh, it's gone now.
Am I audible?
Now you're audible. Now
Yes.
audible.
Am I
Yes.
audible now?
Yeah, you're audible now. Please go ahead.
Okay.
Still.
So like
Chairman, there is some technical problem with audio.
is it fine now, sir? Fine. Yes.
It's okay.
I'm so sorry about it. Like how Roy sir rightly said, the classroom style of approach that Raghuram sir conducted the class was truly great. The session. It was, I think, for me personally, first kind of an experience where he took line by line without any PPT, nothing. So it was a great experience. Wholeheartedly thanking Raghuram sir once again on behalf of each one of us here. And also to special thanks to Accounting Standards Board. Vaishali ji was of great support. For anything, she was just a WhatsApp away. Any phone call, she got everything fixed, everything. So kind of her and the entire team. And MPV sir, of course, for having joined us. Thanking all the participants for your great participation on all 3 days. Look forward to more of your participation for many projects, many more of our initiatives and programs coming ahead, sir. So thanking each one of you once again, handing it over back to Roy, sir.
Nothing more to add. It was a wonderful experience for the last 3 days. I think we look forward to meeting you in our future online, maybe physical form of meetings. I think